Hello and welcome to Season 2, Episode 3 of the Talking Central Banks podcast with me, Karan Merishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about central bank independence in the era of political interference in monetary policy. Our guest tonight is Joseph S. Tracy, who was previously the Executive Vice President and Senior Advisor to the President at the Fed Reserve, Dallas, between 2017 and 22. Prior to joining the Dallas Fed, Joe was the Executive Vice President and Senior Advisor to the President at the Fed Reserve Bank, New York. He also served as the Fed New York's Director of Research. Before joining the Fed New York, Joe held appointments with economics departments at Yale and Columbia. He is currently a distinguished fellow at the Daniels School of Business at Purdue University and a non-resident senior fellow at the American Enterprise Institute. Welcome to the show, Joe.
It's great to be here. Thank you for having me.
It's an honor. Talking about the Fed's dual mandate, Joe, several challenges were faced by the Fed in 2025 and continuing into this year, in a way exacerbated by the dual mandate. The context here is that other large central banks across the world have a single or a primary mandate focusing on inflation. You have spoken and written extensively on this topic, Joe. Can you please elaborate your position here?
I think the fact that many governments have given their central banks either a single mandate on inflation or made it at least a primary uh, simplifies the job facing that central bank and certainly focuses what their mission is. For the Fed, again, it's unusual that it was given a dual mandate of stable prices, but also employment growth, and that they are to be treated sort of approximately as co-equal parts of a mandate. Now, in sometimes, if the primary thing happening to the U.S. economy is demand shocks, then that doesn't pose a problem for the Fed because it can basically manage both sides of its mandate with its sort of a single policy. The challenge is when the economy is hit by supply shocks. So think of the disruptions from the COVID pandemic in terms of supply chains, and more recently, I think the significant use of tariffs and the uncertainty over tariffs. That creates a problem for the Fed with the dual mandate, and that an adverse supply shock is going to tend to put upward pressure on inflation and then weaken the labor market. And at that point, the Fed has to choose which side of the mandate to focus on. It can no longer support sort of equally both sides. And I think that has been the challenge facing the Fed recently. And as you know, their decision to cut their policy rate 3 times by 25 basis points last year was based on a decision to focus more on the employment side than on the inflation side. And then they had challenges to communication because they were talking about sort of a balancing of risks to both sides of the mandate. That's just telling you they're struggling with this fact that they can't basically deal with both simultaneously. It also, the dual mandate opens up opportunities for administrations to put pressure on the Fed. And the pressure usually is coming before elections, either the general or midterm elections, and administrations would like the economy growing faster. Uh, that pressure they can apply on the Fed because of the dual mandate, because of that employment side.
Right.
If they only had an inflation mandate, it would be rather difficult for the administration last year and going into this year to be pressuring the Fed to lower their interest rates because inflation has been above their mandated target level. And so I think that has also created problems for the Fed, where it has opened the door for more political interference.
Right. So, in your opinion, Joe, what are the potential risks to the Fed's reputation in the light of the prevailing Powell-Trump conflict ongoing right now?
Well, I think one of the, especially on inflation, one of the most important things to for a central bank is to have credibility that it will be achieving its inflation mandate. In the U.S., we had the very high inflation of the late 70s, early 80s, and a very costly, basically long-term effort by the Fed to bring that back down and to build up its inflation credibility. And so that I think is the biggest risk is central banks, if they are perceived as giving in to political pressure, are going to risk the credibility over inflation. And if that happens, then I think we'll see inflation probably move higher, and it'll be more an even more difficult challenge for the Fed to bring it back down to 2%.
Right. In general, Joe, in your personal experience, how should central bank leaders react to political criticism? This is in the context of Powell going public with the news of investigation against him. Do you think this reduces the public's confidence on the central bank of the Fed's stature?
I think the most important thing for the central bank to do whenever they're under pressure is to reassure the public that they are not going to let that influence their decisions.
Right,
I think it's fine to be transparent about the types of pressures that an administration is putting on the Fed. But what the public wants to hear is that the Fed will basically continue to try to do its job to the best of its ability and not be influenced by this outside pressure or even just distracted by this outside pressure. I think the other thing that helps in the situations like this is the decision many years ago to accelerate the publication of the minutes of the
right.
meetings prior to the next meeting because that gives you readers more detail about the diverse discussions that were happening. And I think if they can read the minutes and see that there really is an honest debate going on around the table and lots of diverse information being brought to bear and not a focus on the political pressure, that will help reassure, I think, the public and markets that the Fed is doing its best job to make the best policy decisions for, again, trying to deal with the challenge of its dual mandate.
What legal mechanisms exist to protect central banks from political interference in the US, Joe? Do you have any examples when this was actually tested in the historical context?
Well, not for the US. We have many examples for foreign countries where the heads of central banks were simply just replaced
Right.
uh, by politicians. The design of the U.S. Has central bank has sort of many features built into it. An important one, which is basically under scrutiny right now, is the staggered 14-year terms of the governors. And so that was a compromise between like the Supreme Court, where we have lifetime terms. So they really wanted to insulate the Supreme Court from any sort of political influence.
Right.
And, shorter, like a 4-year, 5-year term. And it's important they were staggered so that any president basically stepping in is going to have a central bank, at least the board composition, which represents people who were appointed by prior administrations. So you don't have the ability of any one administration to sort of appoint generally a majority of the board. But it's important that governors can serve that 14. Well, most of them don't serve the full 14 years, but they can serve at their discretion up to that 14 years. And so I think right now, key is the Supreme Court review of Governor Cook and the attempt by the president to dismiss her. It's really important that the court agree that she should continue in her job responsibilities as any ongoing investigation is carried out. And hopefully, in the end, take a very narrow view of what the for cause means in terms of an ability of the president to replace a governor. The other thing that supports the Fed's independence is that they have budgetary independence.
Right.
And that means that the Congress can't put pressure on the Fed through the budgetary process. Now, we can come back to this topic, but I think that gotten stressed by the balance sheet policies that the Fed has followed during the financial crisis and COVID, in a sense that it led to significant revenues being remitted back to the Treasury, but then also more recently, lots of IOUs building up as the Fed was
Right.
running deficits. And so I think that's a bit of a challenge right now with this question of budgetary independence. Certainly, when the Fed was running these big surpluses, Congress decided that they could use the Fed's balance sheet for other purposes like funding the CFPB.
Right.
And that's a problem. And so it would be better in some sense, and we'll come back to this, I'm sure, for the Fed to be running a smaller balance sheet to help maintain that sort of funding independence.
Central bank independence, Joe, contributes to price stability as an independent central bank takes a more conservative approach. Some empirical studies have also found that a lack of independence can undermine the credibility of a central bank's commitment to price stability. Keen to know your thoughts on this since you are an advocate of price stability as a primary mandate of the Fed. Joe.
Yeah, I think experience and research has shown that if the focus is on the long-term performance of economies, that that is well supported by low and stable inflation.
Right.
And I mean, Greenspan was a big proponent of this, saying, and I think Greenspan articulated that yes, Congress gave us a dual mandate, but probably the inflation one should be, treated more importantly because in the long run, without meeting that side of the mandate, it's going to be very difficult to be meeting the sustainable employment growth side. And so to achieve low and stable inflation, central banks have to be focused on the long term.
Right.
And that means, that they can't be influenced by sort of short-term considerations, especially ones that follow more of a political cycle. Whereas again, politicians are more interested in things like an upcoming election and are willing
Right.
to basically trade off a little more growth now for the risk of more inflation maybe down the road, because down the road is after the election, and then they'll just
Right.
deal with that. And that's where you get that instability in inflation. It starts to basically follow this political cycle. And so I think that's why we really do want central banks to be insulated from this political pressure so they can keep their focus really on the long term and not sort of what's happening, with an election coming up in the next year.
If I say, Joe, that a government generally uses uh, its central bank's power to issue money as a means to finance its fiscal deficit, then it can be implied that an inflation bias can result from the time inconsistency problem of monetary policy making, which in turn may lose its ability to anchor public expectations. Given the political pressure on the Fed to reduce rates at this time, when core inflation is still sticky, do you think that the Fed might be forced to abandon its long-run inflation management goals and lose its credibility as the world's premier torch-bearing monetary policy ivory tower?
Yeah, I think part of the challenge facing the Fed right now is maybe an unintended consequence of the very low policy rate and therefore low interest rate environments that it helped to foster to try to sort of get the economy growing again after the financial crisis. And this created sort of these, new views about deficits and the modern monetary theory, questioning why governments don't borrow more money because look how low the interest rate is on this. And certainly they can find investments that can pay more than that in terms of a return. And so I think part of the discipline on federal debt was lost there under the mistaken view that these low interest rates were going to be, out forever. And of course, what we saw, post COVID with the inflation rising rapidly is the central bank had to react. Again, I would say they reacted about a year too late, but we can come
Right.
back to that.
Yeah.
Um, and so now we're, governments, not just the U.S., but others are facing, higher interest burdens on their debt because they grew the debt, but also interest rates are rising. But what's ironic about the administration putting pressure on the central bank, in our case, the Fed, is one of their goals is they would like to reduce that 10-year Treasury rate. But if the bond market thinks that the Fed is caving into Fed to pressure from the administration, they're going to basically factor in a higher inflation premium, and those 10-year Treasury rates are going to go up. And similarly,
Right.
mortgage rates aren't going to go down if the bond market feels like the Fed is caving on inflation. So, not sure why even success by an administration in terms of this pressure campaign is actually going to deliver sort of those lower interest rates. I think the best thing that the Fed can do is to convince the market that they are not going to allow the deficit problem to be dealt with through an inflation tax and
Right.
really squarely put it back into the administration and Congress, say we really need to right size our federal government spending, which has risen. I mean, despite all the discussion around different tax reforms, federal income taxes as a percent of GDP vary pretty narrowly, and over time, and so that growing deficits are caused not by a reduction in tax revenues, but a significant increase in spending. And we simply have to go back and sort of re-examine what we want the federal government to do and start to get the spending realigned back with the tax revenues.
Do you think it's going to be challenging, Joe, given the fact that what happened to Japanese bonds uh, a week ago?
Yeah, I mean, already you're seeing some challenges facing the UK and
Yeah.
France. This is no longer, we're no longer talking about, Greece and Italy. And so at some point with these, if there's no view in the markets that the US government is going to basically start to seriously deal with this deficit, because remember, the economy has been expanding.
Right.
So these deficits are not caused by a major war like they have been in the past or a very significant recession. Um, then the bond markets are going to basically start demanding a risk premium.
Right.
And that is going to just make the problem more challenging. So we really need to basically get the government to actually start, working together, especially Congress, in terms of making hard decisions. We also haven't directly addressed the entitlement issue now for a long period of time, and that problem is
Right.
only growing. So this is going to just take basically people in Congress and administration to really sit down and say we have to start figuring out, where to cut
Right.
and be honest to the American public. The answer isn't just to raise taxes. I mean, France is already sort of running into this problem that that's not the source of the problem. It's a spending problem. No household would, be managing itself like this and expect things to go well. And so it's a challenging problem, but if Congress is always in this winner take all mode, then we're not going to make any progress on this. So they really have to start reaching across the aisle and say, this is a shared problem. Let's start finding some ways to cut and what the priorities of the federal government really should be versus what state and localities can take care of.
Right. Some economists, Joe, argue in favor of government interference in monetary policy, as central banks are often observed to be more inflation averse, sometimes even more than needed. This is in the context of higher for longer periods of for post-COVID having debilitating effects on the recovering economies. In your opinion, if central banks come to have the same preferences as their governments, maybe through better fiscal monetary coordination, will it help in better policy framing and implementation?
Well, I think an advantage if Congress decided to give the Fed just the single mandate on inflation, that would help create a clear separation, I think, between monetary policy and fiscal policy. Right now, with the dual mandate, monetary policy is also trying to accomplish things that really are in sort of the bailiwick for fiscal policy. And as I said, that opens the door for pressure from administrations. And so I think if we had just that, price stability mandate, then, that would create accountability. The Fed is going to be accountable through its monetary policy for inflation. You could hold the administration and Congress accountable for economic growth through fiscal policy. And then in that world, hopefully we could get back to what I guess I call the Rubin Doctrine, which
Right.
was the administration doesn't publicly criticize monetary policy. The Fed chair doesn't publicly criticize the Congress or administration, but there is frequent dialogue, quiet dialogue between the Treasury Secretary and the chair, which helps that sort of, coordination between monetary policy and fiscal policy. And I think that would just be a more manageable situation. And we could avoid a lot of the theatrics that are going on last year and into this year.
Right. Since the financial crisis, Joe, many central banks pay major attention to financial stability, sometimes because they have been given explicit responsibility for macroprudential supervision, and sometimes because they are now financial stability as essential to traditional pursuit of macroeconomic stability, as suggested by Cerruti et al. In their 2016 paper. In this context, Joe, do you think central banks are more cautious post the GFC? And importantly, is that a good thing, in your opinion?
I think we learned an important lesson. I think there was a view leading up to the financial crisis that I'll call it microprudential supervision was sufficient if done well. That
Right.
if we make sure that the key financial institutions in the banking system are well capitalized and do appropriate risk management, then even if credit is being shifted out to the shadow banking system and that runs into problems, the banking system, the formal system, will be able to sort of absorb that back on, and the economy will do okay. And what we found from the financial crisis is that didn't happen. Just these adverse feedback loops, I think, were too severe. And so that really did raise this question of more macro prudential, I think, supervision. The other thing that came out of that I think was very important was the other role of a central bank that we haven't talked about, which is the lender of last resort.
Right.
And so we know that, when with asymmetric information that gets worse under, periods of market stress, solvent institutions can run into liquidity problems and then be forced, if they don't have access to a lender of last resort, forced to sell assets at losses, and then they can go insolvent. And so one of the challenges was making sure that key parts of the financial system did have access to some kind of lender of last resort. So extending that function for the Fed, but then also thinking about this role in a crisis of having a central bank work with the Fed, work with Treasury to come up with these special facilities. A lot of criticisms of those, but again, many of them were simply extending kind of this lender of last resort function. I think with the retrospective, making sure that these were really done in cooperation with Treasury and the support of Treasury is a good thing. It is going to be, we'll have to see how it works. This idea of restricting the ability to have these support for individual institutions. It has to be now broad markets. So no AIG. that, not being able to sort of deal with the problem from that financial products and the CDS market, that it could be challenging under the new regime. But I do think that it was important to sort of realize the interconnections in finance, and also it's getting more global. So this is
Right.
requiring much more cooperation and even data sharing among central banks globally. And so now we didn't have it during the financial crisis. There is a data center at the BIS, which is aggregating data across all the home supervisors, providing a better view of the interconnections in the financial system, not just domestically, but globally. And so these are important, I think, developments from the financial crisis. And I think it has it, whether central banks are more cautious, I think they are in the sense of a view that what we don't know is really important oftentimes. And so we don't want to be overconfident that the system is going to be able to handle different stresses and be prepared to how we're going to step in those cases where we're going to be surprised about something that's going on in the financial system.
Right. So, Joe, the moot point here is that do you think the central bank independence changed since the GFC and then after COVID?
Well, I would bet if we went back and looked at the Senate confirmations of Fed governors 30, 40 years ago, they'd be mostly non-events in terms of the public, mostly bipartisan, very few votes against. We look more recently and big news events, very partisan votes. You ask, why is this happening? Well, you could say the same thing about Supreme Court nominations. If you go back
Right.
pre-Bork, mostly consensus, qualifications of the candidate, they were not sort of politicized. And so, again, I think this is a repercussion of the fact that our Congress and administration have not been doing what they need to be doing and have looked for other, like the Supreme Court, to basically handle problems or for the central bank to handle problems.
Right.
So we definitely get back to this question. We need to get sort of Congress and administrations sort of working. Uh, and I think the big change since the really during the financial crisis was the footprint of the Fed in the economy. So if you go back and look at the Fed's balance sheet pre-financial crisis, less than $1 trillion, short-term treasuries, no mortgage-backed securities or agency debt,
Right.
very liquid. No way the Fed would lose money on that balance sheet, even if it had to aggressively, raise interest rates. Uh, no way you would say the central bank was channeling policy to any particular sector. It worked
Right.
through, treasuries, and then that got intermediated out into the economy. And then at, the height of COVID, a $9 trillion balance sheet. Mortgage-backed securities being purchased in significant quantities, even when the housing market was doing well.
Right.
So this, I think, I would argue, basically with a case where the balance sheet was too big relative to the political accountability of the Fed. And then in that just intensifies the focus on the Fed.
Right.
Uh, and the other way is I think that basically central banks should be operating their monetary policy through what I call sort of this expectations channel of interest rates, uh, and not by trying to suppress term premiums in the bond market, which essentially is what these balance sheet policies do. Central banks
Right.
become a sort of rate insensitive buyer,
Mm.
and they're going to buy at whatever price it takes to hit their target, acquisitions in that auction. And that basically just forced the trim premium down to zero, which is a form of price
Right.
control in
Right.
the bond market. And we know from all kinds of experience that price controls actually have lots of bad consequences in each market where they're used. And that would also apply to the bond market. And so I also think it's just not a good idea for central banks to basically be trying to interfere with the term premium. Now, then you would say, well, what should a central bank do if their policy rate is at zero? They could use some forward guidance like the Fed did. But if
Right.
that's it, are you saying they shouldn't use their balance sheet? And this goes back to Draghi. Well, the central bank will do whatever it takes.
Yeah.
I would argue that's not correct. I
Yeah.
would argue the government should do whatever it takes,
Right.
but the central bank should say we're at the limits of what we can do. Now the responsibility is being handed over to the administration. This is really now a fiscal policy issue, not a monetary policy. And I think if we had done that even in the financial crisis, without these large balance sheets, we wouldn't probably have as much focus, on the Fed. And some central banks are, having done a review of those policies, are moving away from them, moving back more to the traditional smaller balance sheets. I have not heard about any discussions by the Fed on that line. Well, in fact, they're
Right.
growing the balance sheet again now. But I do feel like an important sort of discussion to have. And do we really want to be using the balance sheet in the future like we did in the past? I
Mm.
would prefer if the central bank sort of went back to the much smaller balance sheet and went back to basically short-term treasuries. And I think that longer term would help preserve the independence of the central bank.
So, in your opinion, Joe, the quality and the size of the balance sheet has a direct bearing over how independent the Fed is. Is that true? Uh,
Well, the risk, governments like balance sheets.
right.
Go back
Yeah.
to the GSEs when they had, they had those big balance sheets, and the Congress said, "All right, well, we're going to impose all kinds of affordable housing mandates on you." There was no way with their lending policies they could make those loans. So the only way they could meet these affordable housing mandates is they had to buy those loans and put them on their balance sheet. And so that ended up being a significant source of loss, not the credit losses on the mortgages they guaranteed. It was all of these non-prime mortgages that they were buying on their balance sheet because of Congress's mandates. The Fed balance sheet starts to rise, and suddenly Congress says, well, let's have you fund another agency on your balance sheet. Imagine Congress says, wow, the Fed had a $9 trillion balance sheet. We think we should expand the instruments that you are allowed to purchase. So we're going to change the Federal Reserve Act and allow you to now buy corporate debt and equity.
Right.
And along the way, we've got some suggestions for what we'd like to see you being investing in. So you
Mm.
can see the problems. There's such a strong incentive for Congress to basically want to use any balance sheet for its own purposes because it's a way of doing work off balance sheet in some sense. And I think that is really problematic. None of that could happen again if the Fed is running a pretty small, plain vanilla short term treasury balance sheet. It takes all that temptation away.
Right.
Not to say that Congress would actually do that, but that is a risk. And certainly other central banks have been given the authority to buy a broader set of securities on the markets and have been pressured to do so. And I think that would be a very sad day for the Fed if that is something that emerged down the road.
So, basically, it's what the Bank of Japan does in any case. So that's a good example here for the Fed.
Yes.
Yeah.
And so, and again, I think it's just kind of it's this question of what is monetary policy and what should be done by fiscal policy, and if things become serious enough, should sort of it be more of a handover to the fiscal policy. At least there's the political accountability there.
Right.
It's not to say that the administration and Congress at that moment are going to basically do exactly what maybe should happen, but if they don't, people can vote them out. And we
Right.
don't have that same level of political accountability. Much like I think support for the Supreme Court. depends a lot on the view that they are not trying to make legislation. They are simply trying to interpret whether or not the legislation is consistent with, the Constitution and with case law. And so having a more narrow focus supports independence. But if any group starts to overreach, then the risk is to increase the political accountability of the Fed.
Right.
And so we've already had proposals in the past to make at least the president of the New York Fed, who is basically the vice chair of the FOMC by tradition. Well, maybe that should be a political appointment, with advice and consent. Or maybe all 12 Reserve Bank presidents should be political appointments.
Right.
And so that is the risk, is that this kind of federated model we have basically will have to come under more political control if the Fed is going to maintain this outsized influence on the economy. So if we believe it's good to have the current structure, I think we need to right size the footprint and go back to a smaller footprint in the economy.
Right. These days, Joe, the inflation problem in most leading economies is that inflation is too low, and you just mentioned about that, and not too high. And this has led to the use of different monetary policy instruments across the world. Before the GFC, monetary policy makers in most countries primarily relied on short-term tools, such as mostly overnight call rates modulation and other money market rates to maintain price stability. Under this framework, policymakers would announce a desired level of the policy rate and enforce it relatively easily, along with the liquidity management operations. This way, monetary policy could be implemented without any significant changes in central bank's balance sheet. This was the classic time consistency principle in monetary policy. Now, central banks are using multiple tools, including the rise of gold holdings backing the currency in circulation, or M0, a rapid leverage of central bank balance sheets, the example of QE and QT, radical open market operations, etc. Given this background, Joe, what in your opinion of this evolution? Also, do you think central bank independence is important while taking QE decisions as compared to other monetary policy tools, given the former's fundamental market making implications?
So implementing monetary policy under the Fed's old regime, I'll call it the quarter system, was a little more labor intensive
Right.
because, and people have to understand that the federal funds rate is a market determined rate. It's not set by the Fed. And there was an active overnight market for reserves between banks back in the day because we paid no interest on reserves and banks faced a required reserve where if they didn't meet it over a reserve period, would be subject to penalties. So that led to active borrowing and lending of reserves. But the interest rate was a market determined rate. What the Fed controlled was the supply of reserves. And so what was required was a very good understanding of where the demand for reserves were going to be on any given day and adjusting the supply. Most of the adjustments would be temporary adjustments due to temporary increases or decreases in the demand for the reserves, but they would also have to be mindful of longer term, more persistent changes. And there would be a call every morning between the New York Fed and the Board of Governors. Federal Reserve bank presidents could call in and join the call. I was always impressed with President Yellen in San Francisco at the time,
Right.
calling in very early in the morning to be
Mm.
on those calls. But that's where basically the decisions were made as to what sort of supply adjustments to do for that day. And then they would direct the markets group to execute that. And they actually, if you go back and look at the actual effective federal funds rate during that period, They did a very good job of keeping it quite close to the target that was set by the FOMC at the
Right.
prior meeting. There would be some volatility at certain points in the year, toward year end in particular, but I would say that it worked reasonably well. One of the challenges with that, obviously, we saw with 9/11, is that you don't have an independent sort of liquidity policy and monetary policy. So there was a decision there because of disruption in sort of just the whole financial network to flood the market with liquidity, and then the Fed funds rate traded low. Moving to these floor systems, basically paying an interest on reserves and then adding a significant quantity out there, they no longer have to do these day-to-day adjustments. But as we said, the difference is they're now running a much bigger balance sheet.
Hmm.
And my view is that, again, I think they did a pretty good job in the old regime, and it allowed them to do it with a much smaller balance sheet and not taking any interest rate duration risk like they did following the financial crisis and certainly COVID. And, again, that is really trying to just work through that expectations channel of short-term interest rates into longer-term interest rates and allowing that to be intermediated out into the economy. Um, the Fed did try this forward guidance initially under the Bernanke Fed when the policy rate was at zero. The tension with that, well, the point of it was to say, convincing the markets that the Fed is going to keep its policy rate at zero longer than the markets were currently expecting. That would put to that expectations channel downward pressure on long-term interest rates. The delicate issue there is the committee needs the market to think that that's credible forward guidance, but the reality is their future committees are going to be making those policy decisions. So, to what extent are you trying to tie the hands of future FOMC committees? So that's where you get into some challenges with this timing consistency. Um, but I do feel like that system worked pretty well, and it is certainly one in which I think, as we've talked about, there would be less focus on the Fed, and the Fed would have a smaller footprint in the economy. And that I think would be a good thing in the current environment.
Right. By the way, Joe, what is your view on the importance of central bank independence in managing higher debt sustainability of a country? And I think sovereign debt management is a flavor of the season. So keen to know your thoughts on that.
Yeah, what I think is really important is that for the U.S., and this would be true for other developed countries, is for the bond markets, which are now not just domestic, it's international in terms of where that investment demand is, that they really feel like the central bank is going to stay very focused on inflation, because the real worry for investors is the government simply going to print money, be allowed to print money, and inflate that high debt away.
Right.
In which case, once that view forms, then interest rates are off to the races. And so, if Congress and the administration feel like maybe the Fed will help solve this deficit problem, it takes the pressure off of them, but the pressure needs to stay on them because the
Right.
problem is not a monetary policy problem. The problem is just a spending problem. Um, Now, that doesn't mean that they will necessarily deal with it, but I think it's important for the markets to believe like they can't hand that off to the Fed, because that will just mean very high inflation. And so it's doubly important for the Fed to keep this credibility over inflation, to keep those inflation expectations anchored, especially when these deficits are rising. But again, even if the central bank does that, at some point, investors may start losing confidence. in treasuries and backing away. And that is why, I think the US has some time, but it's not an infinite amount of time.
Right. Several authors, Joe, provide political explanations for why delegating to independent monetary authorities might be attractive. For instance, according to Bernhard's 1998 paper, information asymmetries create potential conflicts between different political actors, such as backbench legislators, coalition partners, and government ministers. What is your stand in this debate, Joe?
It's interesting when you look at the design of the Fed, and also with the idea that the US has had a kind of a tortured relationship with what I'll call central banks. So, I think Hamilton saw the importance of having something like a central bank. He thought it was very important for the new country to establish a credit rating, to not allow states to defaulting on their debt,
Right,
and also that the new government didn't have a lot of sources of taxes. Mostly it was import taxes, but it was going to need to have a banker. And so the
right,
First National Bank was the closest thing we had to kind of a central bank then. And then, its charter lapsed. And then the Second National Bank, again, because of the conflict 1812 with Britain, again, talking about central banks helping to finance wars. And then interesting that, one of the most popular generals from that was then elected probably our first populist president. And Jackson refused to renew the second national bank charter. And then remarkably, from the early 1800s to 1913, a massive growth in U.S. economy with no central bank. But we had many, many cycles of sort of bank panics, so that lender of
right,
last resort function not being in place. And it was really the panic in 1907 that finally convinced the country, A, JP Morgan wasn't going to be around forever to sort of fix it, and the economy was getting too big and complicated. But when they came up with this design, it looked very different from any other central bank at the time. Most central banks were seated in the sort of the political center of the country. And so we have the Board of Governors, which sort of follows that. But then these 12 independent reserve banks, a federated system, that was kind of an innovation. But I think it was partly because of this kind of unease with having central banks be dominated by the politics of the
right.
moment, by being situated in the political
Mm.
capitals of countries. So I think they viewed the 12 independent reserve banks as being a break on that, and to make sure that perspectives from all parts of the country would be represented at policy meetings, and they wouldn't just be dominated by whatever the conversation was in Washington, D.C. at the time. And I think even though that complicates, the decision making, because now you have a committee at full staff of 19, I think it helps make sure that they have sort of wide-ranging discussions. And to get back to our earlier points with the publication of the minutes, I think it helps the public see there really is a diversity of views. And that's important, I think, for people to believe that the Fed is not dominated by one part of the country. That was another problem with the earlier central banks, is that they figured out it favors the New England states over the middle or southern states. Well, having reserve banks spread across the country sort of gives that nice balance of sort of interest. And so I think that is something that is worth preserving, and also the reason why I wouldn't want the presidents of these reserve banks to become political appointments.
Right. Finally, Joe, some models are suggesting quarter four to grow at over 5% actually. At the same time, Governor Waller seems to be tolerant of a higher inflation print, as apparent from his recent commentaries. And Miran also acknowledged that goods inflation might remain high. Possibly the high tariffs on trading partners is a reason here. In any case, this might have implications on the Philip curve and inflation anchoring going forward. What do you make of this in the current political climate, Joe?
It reminds me a little bit of the period when Greenspan was the chair and we had the sort of the internet sort of build out. And he was of the opinion that this was going to lead to a favorable sort of supply dynamic and argued for the Fed to not necessarily tighten policy. So I think one could take a similar optimistic view of this AI. What we're experiencing now is mostly the capital investment in the technology, much like the early capital investment in the internet. That's going to be very concentrated, but relatively maybe short-lived. The long tail is really how businesses finally learn how to best utilize this technology. The same, with any technology. That could go on for quite a long time. And I think that has this potential of if, one of the challenges for developed countries is slowing labor supply growth. And anything that increases labor productivity helps to deal with a slowing labor supply growth in terms of then output growth. So this could be a very welcomed thing for the U.S. and other developed countries in that it allows this smaller sort of labor force to continue to be expanding, output and production. And it should help put downward pressure on prices in the future. So that would be a very good thing. Now, yes, there's going to be some structural unemployment, readjustments. People are going to have to be sort of changing jobs. But also, as companies experience these efficiencies, they're going to grow. And that means they're going to be adding other types of jobs that they need. Uh, so I think this is all a good thing. And ultimately, again, this could be a favorable supply shock. And again, more productivity growth can help at the margin with that deficit problem we talked about. So the best way to deal with to get sort of deficits down is to grow the economy faster. As long as we're not just spending more money at the time that we're growing the economy. But I think if the economy is growing faster and we get some kind of spending discipline, those two could go a very long way to helping to reduce those deficits relative to GDP. And that's the more favorable sort of view. That's what we really need to be, working toward. Um, and again, I think what would be helpful, and imagine the Trump second administration with, the policies to streamline, regulations to try to kind of re-energize our energy sector. And even some of the efficiencies that, in terms of the federal government. But imagine we didn't have all this uncertainty that's been created over immigration policies and in particular tariff policies. I think the economy would even be stronger. So there's a lot of positives. It's just that we've also created a lot of policy uncertainty, and that causes some hesitation by firms on investing. And I think that has held back, in some sense, the growth that we'd be getting from this. But hopefully, if this uncertainty starts to diminish, then we're going to see, a strong economy going forward, and that's a good thing.
So going forward, it probably means, Joe, that the Taylor rule will have a lower weight for inflation. I mean, that's general understanding that we can take from this.
Well, I think John would always say the Taylor principle is the key, which is if inflation increases and you're trying to bring it down, you need to raise the real policy rate. But you may be right that we can keep the Taylor principle, but we might not have to be quite as aggressive.
Right.
And so, yeah, it's always better if you can tap on the brakes versus have to really brake hard. And if these technologies provide a nice, steady sort of wind at the back of the economy, then that should help certainly the Fed in terms of its work. I guess the other question would be if the Fed only had a single mandate of price stability, would that, even though it's a smaller coefficient, would that change the coefficient on sort of the unemployment gap?
Right.
There in that world, the Fed would be focusing on the unemployment only as how it influences its view of forecast for inflation. And it might also, in a single mandate, say, maybe that coefficient gets tweaked as well.
Very interesting, Joe. Well, on that note, that's all I have for today. It was an honor speaking with you, Joe. Thanks once again for the time.
Very good questions and broad ranging. Thank you.
You're very welcome.